Hello friends, welcome to my YouTube channel. Today we are going to discuss some of the most commonly asked interview questions for accounting SAT service jobs. Whether you are a recent graduate, an expertise accountant, or a professional looking to transition into a SAT service role, this video is designed to help you prepare for your next interview. In this video, I will cover a range of topics from general accounting principles to SAT service specific questions and provide you with tips and advice on how to answer them confidently and effectively. So let's get started. So I'll start with question and answer relating to P2P, that is purchase to payment. The first question is explain the complete flow of procure to pay process. Okay. So here the interviewer is trying to understand, do you know the process flow completely from the procurement to pay? So let's understand what are the processes followed. The first would be the purchase requisition, which will be raised by the requester. It could be the business team, it could be the internal team who want the service or who want the material has to raise a PR, correct? Once the PR is raised, it is the responsibility of the purchase department to collect quotation from different vendors and examine their strengths and weakness. Then once the vendor is identified, what will happen? The purchase department will issue purchase order. So purchase order is a legal document. It's equal to like an agreement. So the purchase order will specify the quantity and the rates, whatever is negotiated and agreed between the buyer and the seller. And the vendor supplies material and services as defined or as mentioned in the purchase order. What happens next? Once the material is received, the person who receives the material or the business who receives the material will prepare the GRN note in the system stating that what is the total quantity of material he has received. And once the GRN is prepared, the accounting payable team will ensure that the invoice and the GRN is matched, and based on that the accounting team will post the accounting entry. And after all verification, the accounts team will account the invoice, and based on the due dates, the payment will be released by the accounting team. Coming to the next question, what is a three-way match? This is one of the critical process which the accounts payable team has to follow every day whenever they process the invoice. So let's understand what is three-way match. Three-way matching is an accounts payable process that compares an invoice to the corresponding purchase order and delivery receipts to ensure that all details matches. It's a standard practice that helps protect against fraud, incorrect invoices, and overpayment. So it's the responsibility of the accounting team to ensure that all the three data matches. And if there is any discrepancies, then they will go back either to the business or to the purchase department to understand why there is a difference between the invoice and the purchase order. Next question, what is vendor reconciliation? Very important process in accounts payable team. So vendor reconciliation is a process that compares a company's internal payment records to vendor statement and invoices to ensure that all records are accurate. The goal is to identify and resolve any discrepancies between the two set of records. That means your books of account has to be matched with the vendor books of accounts. There could be differences between both because it may be a case that you have deducted certain TDS and the vendor has not accounted. You have made payment, the vendor has not accounted, or the vendor would have issued the goods and you have not accounted. So different discrepancies has to be analyzed and all necessary accounting entries has to be posted so that the both books matches. So that is a process which is followed in accounts payable team. Coming to the next question, what is restatement of foreign vendor liability on the reporting date, preparation of financial statement, right? So what happens in this case? All foreign vendor invoices are accounted based on the foreign exchange rate applicable on the date of posting in accounting software. That means if you are receiving invoice on 10th of May, then the exchange rate on 10th of May will be considered while processing the invoice. The liabilities will be restated on the closing date, that is the date on which the balance sheet is prepared, considering the closing forex exchange rate. So few companies take exchange rate published by the central bank, and the difference between the exchange rate of the date of booking and the closing rate will be treated as unrealized forex loss or unrealized forex gain based on the movement of the foreign currency. Let's take an example. Question number 5. XYZ Limited received a professional fee invoice from USA vendor for $1,000. At the time of accounting the invoice, the USD rate was rupees 80. The invoice is payable to the vendor on 13th of April. On the date of preparing the financial statement, that is 31st of March, the closing USD rate was 82. What accounting entry to be posted for the restatement of the vendor liability? So the entry to be posted at the time of processing invoice, this is on the day of invoicing or the day of accounting the invoice. So professional charge is 80,000, that is $1,000 into 80. That is the rate applied is 80. To XYZ Limited is 80,000. Now on the closing date, when you restate, unrealized forex loss or gain of 2,000, the movement between 82 rupees minus 80 is 2. So 2 into 1000 is 2000. So unrealized forex loss debited 2000 to XYZ Limited 2000. So the amount will be parked in unrealized. And the day you make the payment to the vendor, the difference between the rate booked, that is 80, minus the actual rate paid to the vendor, will be treated as realized forex because you are actually making the payment. Unless it is paid, the difference is always unrealized. That means it has not been realized and it is a non-cash item. To question and answer relating to R to R. Okay, it is mostly record to report. So mostly many company call this department as closing department, or you can say general ledger department. So let's see what type of questions you may face if you are going to join this department. What are the information you will find while reading a financial statement? That means mostly the question is asked to you to understand that do you know what are the reports attached in a financial statement? So the answer here, what you are going to give is financial statement provides the information below. Balance sheet, where we talk about assets and liabilities. Profit and loss account, where you can find the profit and loss of the business for a certain period, or it can be quarterly or it can be annually. Statement of change in equity, this is majorly the equity fund of the shareholders. Then cash flow statement, you will find three type of cash flow statements: operating, financing, investing. Then you have notes to accounts, which give clarity about all the items you have displayed in balance sheet and profit and loss account. And then your accounting policies, so that the shareholders can map the policies with the balance sheet and profit and loss account. Coming to the next question, what are the methods used to value inventories? How do you report inventory value when the net realizable value is below cost? Give an example on measurement of inventories. This is the most commonly used interview question relating to inventory. So let's see the answer here. Methods to be used to value is FIFO and weighted average cost. However, if the inventories can't be interchangeable, then specific identification method can be used, like job work. Okay. Inventory has to be valued at cost or net realizable value, whichever is less. This is very important because you can't overstate your inventory if you're not able to realize that amount for the market, right? Example, if cost of inventory valued either in FIFO or weighted average is rupees 10,000 and the net realizable value is 9,000, then the inventory value has to be reduced to 9,000 and the difference of 1,000 will be charged to profit and loss account. Again, this is a unrealized loss, and in subsequent, if the company is able to sell at 10,000, for example, at par, then this 1,000 can be reversed at the time of sale. But if the subsequent event shows that you are able to sell only by lesser amount, then there is no choice. The net realizable value is 9,000. Hence, you have to reduce the inventory to 9,000. The meaning here is that you can't overstate your inventory and give a wrong picture to your shareholders. Coming to the next question, what are the expenses to be added to the asset value for capitalizing in books of accounts? So majorly you have to define what are the ancillary costs which need to be loaded to the asset cost to ensure that the asset is capitalized as per the IFRS requirement or index requirement. So let's see what are the items to be included. Below are the expenses incurred towards asset purchase which needs to be capitalized. The first one is the asset value paid to the supplier. So this will be matching with the invoice value, or you can say the PO which is raised to the supplier for the asset purchase. That value has to be considered. Second, freight and insurance cost, loading and unloading cost, non-creditable taxes, like for example basic custom duty. So if you are importing an asset from any other country, the basic custom duty what is paid at the customs will be considered as cost because you can't take any tax credit for the basic custom duty. And last, any grant received from the government has to be reduced from the cost, because this is the subsidy which you are receiving from the government. So the total cost incurred till you receive the asset in your factory or your place of work minus any subsidy or grant received from the government. Next question. What are the condition documents to be checked for revenue recognition? So this is mostly connected to your IFRS 15 or Ind AS 115. So what are the documents? What are the conditions you are going to check to recognize one particular invoice, whether you have to record in the same month or it has to be deferred? Let's see. So below are the documents to be checked for revenue recognition. Whether risk and reward has been transferred to the buyer on or before reporting date. That is, for example, 31st March when you're closing for the Indian GAAP. Check material outward register if the finished goods has been physically moved out before the reporting date. That means if it is a contract where the Incoterms is X work, then the goods should move out of the factory gate on the last working date. So the material outward registered will help you to understand whether the goods has been moved out or not. And the third one is there is high probability that the consideration will flow to the entity from the customer. Correct? If there is no probability, then you can't recognize revenue. Coming to the next question, what is prepaid expenses? What is the accounting flow for prepaid expenses? How it is different from advance paid to the supplier? So prepaid expenses are the expenses which has been paid to the supplier, but the service from supplier not yet received. In this case, the amount paid to supplier is reported as prepaid expenses, which is a current asset, and every month it is amortized and reported as expenses. In case of advance to supplier, the supplier doesn't give any invoice to account. It's only a cash outflow. Next question. What is the meaning of provision for expenses? Okay. Sometimes people get confused. What is provision? What is accrual? What is real expense to be booked when invoice you receive? So let's get the clarity. What is provision for expenses? Provision for expenses includes the below items. Okay. And this is status on the reporting date. Okay. So invoices which are issued by the vendor but not yet processed by the finance team, you have to take a provision for it. Service received from the vendor but vendor has not issued the invoice, you have to take provision for it. Any contract made with the customer for any discount, rebate, benefits to be provided for the goods already sold, you have to take a provision for it. Provision created for any unfavorable judgment received from government authorities. In that case also, based on the probability or based on certain percentage, the provision can be taken in books. Next question. What are the different types of cash flow reported in cash flow statement? So there are three types. One is cash flow from operating activities, majorly your hardcore business. What are the trade payables, trade receivables are a few examples where you will find what are the real cash you are generating from the operating activities, your main business. Second is cash flow from financing activities. This is more about your source of fund, or you can say application fund is the source where you're receiving the inflow and outflow is recorded. And third is cash flow of investing activities. This is more about your fixed assets or long-term investments, the flow you have to report there. Coming to the next question, what is EBITDA? So EBITDA is earning before interest, tax, depreciation, and amortization. It provides the information to the management about the earning made from operations without considering non-cash items, interest cost, and direct tax paid. Have few questions relating to O2C, order to cash. So if you are joining this department, these few questions will help you to understand what type of questions and answers you need to provide during your interview. The first question is, can you explain the key steps involved in O2C process? So when you attend an interview and if you are going to face, so you are going to join a P2P, they will ask the P2P process. If you are joining O2C, they will ask the O2C process. So let's understand how is the O2C process. The first thing is order creation based on customer requirement. So you have received a purchase order from the customer. You create an order in your system, sales system. Once the order is created, the order is processing respective department. Okay. Then identification and packing of material. So once order is processed, the material is packed as per the requirement of the customer. Once the packing is over, the shipping of metal happens. It could be through rail, road, or you may export through ship. Accounting of the revenue when the risk reward transfer to the customer. This is very important. Not that because you have raised the invoice, you will account it. You have to follow IFRS 15 requirement and accounting of payment received from the customer. So once you receive the payment from the customer, you need to account it and clear the invoice. Coming to the next question, what are the different type of deduction the customer can make while making payment? Correct. So deduction can be as per the requirement of law or can be as per the clause mentioned in the agreement. Tax deducted source, commonly called as TDS, on payment is as per the law requirement. However, below deduction can be as part of the agreement, like retention amount. Certain time, what will happen when there is a contract of capex or huge amount of investments? Then in that case, there could be agreement saying that certain percentage will be retained by the vendor for certain period, and after completion of those period only or milestone, they will release the payment. Second is penalty for not supplying goods on time. And third is damages for goods destroyed during shipment. So these are few examples. There could be many more, and the customer can return these amounts with them. The next question, for transfer to customer, if the Incoterms agreed is X work, FOB, and CIF. So in the previous slide, we understood that the risks and rewards should be transferred to recognize the invoice as revenue for that period. But now let's understand that if the Incoterms are X work, FOB, and CIF, so this Incoterms will be mentioned in the agreement or purchase order. Then we need to understand that at what moment the risks and reward is transferring so that we can recognize the revenue in the books of accounts. So risks and reward is transferred to the customer based on Incoterms agreed and mentioned in the agreement. A, X work when goods moves out of the factory gate. FOB, the date mentioned in the bill of lading, and this is generally issued by the shipping company. And in case of CIF, the date mentioned in the bill of lading issued by the shipping company. So FOB and CIF has one condition, that is date mentioned in the in the bill of lading, and in X work, the day the goods move out of the factory gate. So these are the trigger points when the revenue has to be recognized in the books of accounts. Coming to the last question, X Limited exported finished goods, Incoterm is FOB, to London, and the goods were moved out of the factory gate on 28th September. The goods reached the port on 3rd of October and the bill of lading was issued on 16th October. Can X Limited recognize revenue in the month of September? So here if you see, the invoice was printed or generated from the system on 28th of September. But if you refer to question number 16, in case of FOB, the date of bill of lading is considered as the date of recognizing the revenue. So in this case, if you see here, the revenue will be recognized in the month of October because the bill of lading was issued in the month of October. So this is the last slide, and these are all probable questions which you may face. I would suggest that you go through more questions. I am going to upload few more videos which will help you to practice your questions. Let me know if any specific subject to be covered for the interview questions, which will help you for your preparation for the interview. Watch few more videos on interview questions in my channel. Thank you. Share with your friends and subscribe to the channel. Thank you.